January 11th, 2023, and tomorrow is CPI day. We're going over what Market Radar is seeing the market tell us about tomorrow's CPI print and where we see CPI going over the next few months. So, before we get started, obviously, you go on Twitter, you can find a bunch of people talking about the recession is here. CPI is going to be like 3% at the end of the year. A lot of bullshit, to be honest with you. So, let's start with what we're seeing. Now, obviously, the consensus has year over year figures coming in tomorrow with headline at 6.5% and core at 5.7%. Now, we obviously know that the market continues to be very focused on core CPI, and that's why we have it overlaid on the chart here with blue. So this is the core CPI in blue here on a year over year change, and the white vertical lines are the dates that CPI is released. Now, the last two prints, something very interesting happened. We saw double 30 basis point decline, so 60 basis points in total over the last two prints. And the first print in November actually surprised the bond market. We had the prior print was the peak here, at least the short-term peak in core CPI that happened. October's numbers that came out in November, this was the peak, and the bond market sold off into that. Then we had this 30 basis point decline, which kind of caught the bond market caught it off guard and surprised it to the upside, where we saw bonds starting to form a rally here, a squeeze. And this squeezed all the way into the last print of another 30 basis point climb. Now, the interesting thing here is that the bond market is now lower than where it was in the prior print. It's not as low as it was at the initial print that started the rally, but we are lower than the prior print. Now, if the consensus is saying core is going down another 30 basis points, shouldn't the bond market be much higher, right? That's something you have to ask yourself when you look at the market. You have to say, why are bonds doing what they're doing? Now, we know the bond market is one of the biggest markets out there. And if you compare it to equities, bonds are usually right compared to equities. So with the market rallying off the lows, everyone's obviously all junked up on this idea that, oh, inflation's done, new bull market, risk on time, right? Which, again, risk on is not risk on until the system says it's risk on. But in terms of what the bond market's telling us, the bond market's signaling that something's off here, okay? Either the bond market is going to lag and snap up, or, and that being the bond market is wrong, or the bond market's right and something is going to happen, at least in the short term, with CPI. Meaning, consensus can very well be right here with CPI coming in 30 basis point lower, but the bond market is looking past that and saying something's wrong here, at least ahead of time. Because again, the bond market isn't a 30-day interval or a 30-day clock. It's organic. So it's going to look past just the CPI print. It's going to look past where it sees the market going post, 100 days, 120 days, 60 days. This all being factored in. So the fact we're lower than we were at the last print, something is a rise here. Now, what we're going to also talk about today is what we think is going to happen with bonds. We think there's downside here with bonds. Okay, so we think the bond market is right. Inflation is going to come in, add some volatility, but bonds eventually will revert lower. That's our thesis right now, and that's primarily driven by the fact that bonds are still bearish trend. You can see that with the red background here. This is how we function. We look at trends, we look at momentum. Obviously, bond market bearish trend, lower prices are always possible in bearish trends till the trend is bearish. So the fact it's bearish trend, the fact it's lower than the prior high, the prior CPI reading is just more icing on the cake. But the fact it's bearish trend just gives us confidence that there's downside risk. Now, like I just said, it's lower than the prior high, so that's just more icing on the cake. So now let's go into where we see inflation going in the next few months. I have a chart here with the CPI index in orange year over year. I have the December consensus, which is tomorrow's CPI consensus at 6.5%. So it's about 60 basis points lower than the current. We're looking at a 60 basis points decline into in tomorrow's reading. And then I have a white dotted line here, the 500 basis point mark. Now, what this is it's the barrier, say it's literally a line at 5% inflation. Now, on the bottom of the screen here, I have a map of the recession probabilities, and this is provided to us by the Fed. Now I can open that up here. This is what it is. They call it the smooth US recessions probability. And all this is basically a probability calculation of the prior recessions. You can see here in gray, every time there is a recession, right? This is the shaded areas indicating US recessions. The odds are spiking up dramatically. So if we go back to the chart here, what you'll notice right away is every time we have headline CPI over this 500 basis point mark, going back in history, every time we have it go up and peak, there's a recession, right? We go back, look here, peak, recession, going all the way back to 1969. So this is not something that's just randomly, we're just pulling out, just for this video. So Obviously, for this peak to be rather substantial, we would need to see a recession to crush the inflationary demand, the demand for higher prices, aka demand inflation, right? So, how is this going to go down under 500 basis points if there's no recession? And this would be the first time that it would happen within over 50, 60 years. So, this is something that we're watching. We don't think inflation is going under 500 basis points anytime soon. Nonetheless, that inflation has even peaked. We are still uncertain about that. Our system indicates that inflation still has upside risk. So, we also posted a thread on Twitter yesterday where we discussed the issues of a recession, right? Or the factors of a recession, and the issues with this quote unquote recession that everyone's talking about on Twitter, and why we just don't see it yet. Because there's a lot of factors that we went over, from income, unemployment, disposable personal expenditures, and we broke that down and we went through our system, saying that, look, there's not a strong reason that we're having a recession at the moment. So if that's the case, well, historically, that's what has been needed to cure inflation. And if we don't have that just yet, inflation isn't going to get cured as of yet. Now, we would obviously get some type of confirmation here with lower inflationary numbers if we start seeing the odds of a recession pick up, and more importantly, if we start getting to that deflationary regime signal, which we're still a bit away from. So to wrap this up, we don't think inflation has peaked just yet. At least there's not strong enough evidence to prove that. And we also think the bond market is signaling that something is off with tomorrow's print. Get ready, buckle up. We already know it's going to be an interesting month.